We're just concentrating on Poland, Czech Republic and Slovakia, but clearly I think these are also the markets which the usual institutional investors are let's say, facing. And I mean, it's fully right what you just stated. I mean, you see much more equity coming in, especially which we hadn't had in the past, is you have a lot of equity buyers, pure equity buyers. I mean, in Poland last year, you had a transaction volume of 3.2 billion or something like that. And probably I would say 40% out of that was purely financed by equity. Yeah, when you look at Allianz, when you look at Unions, when you look at Commerz Real, Reef just bought Ronda 1, the biggest office building in Warsaw, for 300 million. Yeah, so I mean, they invest a huge amount of equity, and I think that's the difference to the former times, you know, which is also stabilizing the market a little bit. You know, it's not this high gearing we had in the past at 75, 80%, you know, these things. So I think it's very good for the market, it's stabilizing, but as Mike just said, I mean, the problem really is availability of good transactions.
On the slides which Josh showed earlier, you saw the balance between debt and equity. In 2006, 2007, there were record levels of debt, you know, and we all know that's what then created the problem, oversupply of debt. We now have this huge supply of equity, which is positive, it's great, but I get a sense, and I've felt it recently in the last few months, that certain investors are expecting or hoping to get more debt than previously.
That's true.
And so are the banks then under pressure now to more attractive terms, and then we get ourselves a lot of equity, increasing debt.
Sounds like a good cocktail.
As long as it's not a Molotov cocktail, it's okay.
So
certainly. Yeah. I mean, you know, the crisis in 2009, 2010, the leverage, if banks were willing to leverage, was up to 55%. Investors were happy to get leverage at all here. In the meantime, you're fully right. I mean, leverage is going up. I mean, the banks still feel comfortable because when you're going up from 60 to 65, it's not that dramatic, but it clearly shows a trend. But on the other hand side, as long as we're not going back to 75, 80%, that's okay. On the other hand side, what we didn't have in the past, in the years 7, 8, 9, is we did not have at that time the debt funds, which are now more and more coming up, providing, you know, another 10 percentage points over the 65% LTV, going up to 75, 80% probably. This is something which is new in the market here, and which is getting more and more popular. So I mean, at least some of the investors, they get their 75% LTVs, but now it's a fair mixture between senior and probably junior mezz or second tranche.
I think it's interesting because you know, we view the debt gap as pretty much closed in Europe, and certainly on the continent broadly, with the exception of the peripheral countries of, you know, Spain or Italy or what have you. And so the setup is there. I mean, it'll be really interesting to see the discipline, if you will, that gets exercised by the debt capital markets and the equity capital markets, because I think that the place that I find the oddest situation is the secondary market lacking a recovery, if you will. So if you go beyond prime, the spreads are enormous. I mean, like 400 basis points enormous. So, you know, we've been watching in the UK where, you know, you ran over quickly because this is Central Europe, but if you look at where, you know, there's a real robust economic recovery that's occurring here in the UK. And you're finally seeing over the last 12 to 18 months, the secondary office markets outside of London have come in, you know, 100 or 125 basis points. So to me, that's been the strangest place in the market, and I think you've got to see that tighten up because people are going to have to take risk. The prime market, the numbers are full. I mean, in Warsaw, whether it goes to, you know, 5.5 as your number showed, or it's at 6, but what's prime is still pretty narrowly defined, and that's the case, I think, broadly throughout Europe, and it's certainly even exaggerated in Central and Eastern Europe.
And what's holding that up? Is that because there's a lack of financing, Martin, for those secondary areas? I mean, what's the position with that?
No, I think there is certainly financing for secondary cities available, especially when it comes to retail. I don't see any problem, and Martin, you can confirm that easily here. When it comes to the office sectors, it's different because, I mean, you have to see, I mean, the second biggest city in Poland is Krakow. Krakow has 500,000, 600,000 of office stock, which is almost nothing here. And besides the fact that it's a small market, they do not have real CBD, for example. You know, the buildings are spread out all over the map. And besides that, you have older buildings. And if someone adds a new building at 30,000 square meters, it easily impacts the market immediately. And for me, what most of the secondary cities, especially in the office sector, are too much concentrating on are these BPOs, etc. Yeah, that's a trend at the moment, but this trend can change immediately, and this will impact all the local markets. So for me, the availability of that on the office sector and secondary markets is easily to explain. Yeah, but luckily, it's not for logistics, and it's certainly not for retail.